There are two major changes coming to mortgages in Canada effective December 15th, 2024, and I'm going to go over what those two changes are and give you some specific examples so you can see exactly how this works and how it might pertain to your plans so you can plan for 2025. What's going on, everybody? Welcome back to the channel. Super excited for this one. The much anticipated mortgage changes are finally here, and they're going to be making homes more affordable for Canadians, for the short term at least, which we'll dive into in this video. As always, if at any point you're watching this video, you want to get in touch with me, I've left a link down in the description below where you can book a call directly into my calendar and we can chat about your specific scenario and your plans for 2025. Alternatively, if you're not ready to book a call and you just want to view some properties, there's another link down below that'll take you to a website where you can see all the active listings currently on the market in the Toronto area. And also, while you're watching this video, I want you to really think about how you feel about these mortgage changes, because I feel like it's a little bit of a double-edged sword in the fact that, yes, it's going to be making homes more affordable for Canadians in the short term, but then also bringing more buyers to the market, which could potentially increase competition and maybe raise prices in the long term. So I'm really curious to hear your thoughts. Make sure you leave them down in the comment section below. And of course, if you're liking the content, make sure you subscribe to the channel. So with that being said, let's get into it. So the first rule change is the $1 million cap on insured mortgages. So if you don't know what an insured mortgage is, it's basically any mortgage you take out where you put less than 20% down. Before this rule change on December 15th, the most you could purchase with less than 20% down was $1 million. And now they're changing that to $1.5 million. This rule actually makes a lot of sense because, for larger markets like Toronto and Vancouver, the average price of a freehold home has been over $1 million realistically since 2017. So, if the average price of a home is over $1 million and you need to put a minimum of 20% down, that obviously locks out a lot of people who just don't have, $200,000 sitting around to put towards a house, not to mention that the cost of living in these cities is much higher. So, rents are higher, it's much harder to save. And realistically, that's where you were hearing a lot of people getting into the market only with, their parents' help or inherited money, gift money, where this will actually open up the buyer pool to a lot more people because the minimum down payment requirement is significantly lower now. So let's take a look at what this practically actually looks like. So with the old minimum down payment requirements, you're required to put 5% down on your first $500,000 and then 10% on the balance from $500,000 to $1 million. So if you had bought a home for $500,000, minimum down payment, $25,000, 5%. Let's say you bought one at $750,000, you would pay 5% on the first $500,000, you're 25, plus 10% on the balance from $500 to $750, which would be another $25,000 at $50,000 for a total minimum down payment. And then at $1 million or $999, which was the cap for insured mortgages less than 20% down, your minimum down payment would be $75,000. And if you purchase over $1 million, then you are subject to putting a minimum of 20% down. So you can see the difference from going from $999,999 to $1 million. That $1 change made your minimum down payment $125,000 greater. But here with the new minimum down payment requirements as of December 15, 2024, if you're putting $1 million down, your minimum down payment would be $75 because the rules are 5% on the first $500,000 and then 10% on the balance up to 1.5 instead of $1 million. So that would make your minimum down payment $75 versus the 20% down, which is the old rules, which was $200,000, making it $125,000 cheaper than what it previously was. And I've got a few more examples here just to kind of give you an idea of what minimum down payments are at different price points. At 1.1, you're putting 85 down. At 1.2, you're putting 95 down. At 1.3, you're putting 105 down. At 1.4, 115. And for a maximum of 1.5, this should really be 1.4999, but I'll just kind of round it. The minimum down payment would be $125,000 cheaper, which originally with the old rules, your minimum down payment was $300,000, basically saving you $175,000 on a minimum down payment. Now, this is a pretty interesting change in a few different ways. So obviously, lowering the minimum down payment is going to let a lot more people get into that over $1 million price point, which is like realistically in Toronto, an average home. I know like the old $1 million listing shows that like sounds crazy, but like, if you're in Toronto or Vancouver, you probably know that pretty much everything is a $1 million listing, and that doesn't carry a whole lot of weight anymore. So a lot of people are going to be able to go for those homes with less money down, or maybe less help from parents or inheritance or whatever the case may be. And that's all great. And the goal here is to make real estate more affordable, but by, letting more people access those properties, we're going to increase competition, which could in the long run actually increase prices. That, and historically, there's like this weird little bottleneck of sales that always happens at $999,000 because, people don't have that threshold of going over that $200,000 minimum down payment. So I think it's going to positively affect those types of homes. So we're talking about our, row homes, our semi-detached homes, a lot of those homes that would normally be stuck at that $1 million price. Maybe they're not perfect homes, right? Maybe they're not fully renovated or whatever the case may be. Maybe they listed at $799 or $899 with an offer date, and they only got, one or two offers. A lot of times those homes that could have potentially gone for maybe $1,050,000 or 1.1, only get a couple offers, and maybe those two people are bound by their minimum down payment of $200,000. So the highest they can go is $999. I mean, I know I've sold a handful of homes at that price point because my clients were just like, we don't have the $200K. The most we can go is $999. Now that threshold is being pushed up to $1.5 million. And I think that if you have one of those homes that maybe had the potential of going over $1 million, but kind of got stuck at that $1 million mark, now it has the potential of actually moving past that threshold and going up in price. So like I said, it's kind of like a good change and potentially a bad change. Curious to hear your thoughts down in the comment section below, but we'll get right into change number 2. Change number 2 is effectively stretching the minimum amortization for an insured mortgage. So again, insured mortgage being less than 20% down. Before the rule change, it was 25 years amortization was the most you could take. Now you can take it over 30 years if you're a first-time home buyer or if you are buying a new build. So basically, when you're stretching that loan over a longer period of time, it is going to make your payments cheaper. Previous to the rule change, if you wanted a 30-year AM, you had to put at least 20% down, but now they're opening that up to insured mortgages as well. And this is a really big change when it comes to making homes more affordable and making those payments more affordable. But again, comes with a little bit of a double-edged sword. Yes, your mortgage payments are going to be cheaper on a 30-year AM versus a 25-year AM, which is great. And they will effectively be about 10% cheaper. So let's say your mortgage payment was $5,000 before on the 25-year AM. Now it'd be, $4,500, let's say, rough numbers, obviously speaking, which is great. But then you also have another 5 years of incurring interest on that loan. So you are going to be paying more interest on the loan at the expense of having cheaper payments. I will say for most people, this is a trade-off that they are willing to take, especially as this applies to like first-time home buyers. And, usually the first home you buy is not your forever home where you plan on sitting in that home and actually paying your mortgage down for the next 30 years and, having it free and clear at the end of this 30-year period. For most people, this is an investment vehicle, somewhere where they can park their money and their down payment into the home and actually have equity grow over the years as they make mortgage payments and as the market continues to increase in the coming years. And then they will simply move up the real estate ladder, sell this property, take their equity and move on. So the purchase price becomes a lot more important in those scenarios. And most people just want to get into a home that they can enjoy, that they can comfortably live in for the cheapest amount of payments possible. Another way you could look at this is actually it's like getting pre-approved at a cheaper mortgage rate by about 1%. So obviously because we're stretching the loan period out to 30 years, it's making your payments less, which means that you can actually afford more. And it would be basically the equivalent of getting approved at a 1% less rate. So for instance, if you were going and you were getting pre-approved for a 25-year amortization at, let's say, 6%, now that it's stretched to 30 years instead of 25, it would be like getting pre-approved at at 5%, which is obviously going to increase the amount that your pre-approval is for, hence making real estate a little bit more affordable. So again, I think these changes are a good thing. I think some of them are long overdue in the fact that, the old mortgage rules were in effect for so long and prices of homes have gone up significantly since they changed them and they need to make adjustments. I'm still waiting on them to change the land transfer tax system because I'm pretty sure when they implemented that, the average house was like $200,000. And now I think they need to adjust it for homes being $1.5 million, but we'll wait and see on that one. Again, curious to hear your thoughts down in the comment section below, but I think that this is going to have a really good effect on the market in the short term. I think it's going to help a lot of people who couldn't otherwise get into a property that they would desire over $1 million with less money down, which is great and makes homes more affordable in the short term. But I think in the long term, it might help prices creep up a little bit more. I hope that helps give you guys an idea as for the new mortgage changes that are effective December 15, 2024 and how they might impact the market into 2025. As always, if anybody wants to get in touch with me, first link down in the description below. Make sure you like, comment, and subscribe, and we'll see you on the next video.